Hello and welcome to this webinar on raising finance. I'm Peter Quintana from hgkc. We're management consultants. We work with business owners, business leaders, helping them through their challenges, one of which is about raising money. After the stresses of the pandemic combined with Brexit, cash remains resolutely king and cash flow is critical to companies in the current economic climate. Whilst there might be plenty of liquidity out at the moment, as the government support packages begin to close, business owners will increasingly start to turn to alternative sources of funding, such as asset-based lending, invoice funding, financing or crowdfunding. Pandemic has been like an extreme version of due diligence stress testing on businesses and how they've reacted to the challenges that they've had to face. And although it continues to be a challenging time, there are opportunities out there for those looking to grow. So hgkc are delighted to be joined by Matt West of Metro Bank, Toby Jones from StartPoint Finance, and Richard Mojel from ISQ Crowdfunding to learn more about the options that are available to help your business fund growth. So can I start by just asking Toby and Richard to introduce yourselves, please? So Toby, would you start, please?
Yeah, thank you, Peter. Hello, I'm Toby Jones from StartPoint Finance. We're a business finance broker, so we help our customers, small and large businesses, access lenders, and that can either be high street or alternative lenders. Thank you, Peter.
Thank you. Richard.
Hi, I'm Richard. I'm with ISQ Crowdfunding. Clue's probably in the name there. So we support clients, businesses of all sorts, really, startups through to high growth, through to anything really that are looking to raise finance and via the medium of crowdfunding.
Thanks very much, Richard. And Matt, would you introduce yourself as well, please?
Of course, Peter. Thanks, gents, for joining us today. So for those of you who I haven't met before, my name is Matt West, one of the local business managers for Metro Bank covering the southwest of England, helping customers with everything from their transactional banking requirements up to lending packages and everything in between. Like I said, gents, thank you for joining us today. I hope, if you don't mind, if I kick off, Toby, just something I wanted to mention to yourself is, I know you and I have spoken about this over the last couple of weeks, is the recovery loan scheme, which is the next stage of the bounce back loan and the CBILS scheme. I obviously know how it works. We're one of the lenders accredited to the scheme, but do you mind just giving us a little bit of background on how it actually works? Is that okay?
Yeah, sure thing. So like you mentioned, it's the RLS is the replacement by the British Business Bank for CBILS and bounce back loans, which became quite common vocabulary in the last year. What RLS offers is an 80% government guarantee to help businesses access loans or other types of finance if they wouldn't be able to otherwise. It can be, I think probably one of the key things to mention is unlike CBILS, it isn't a standalone product, so it's really more of a bolt-on to existing products like loans and asset finance and invoice finance.
And how have you seen it work? Have you had many inquiries around it at the moment?
Well, it's fair to say the take-up's been a lot lower than CBILS. Probably some, as I'll maybe go into later, some of the terms aren't quite as attractive as CBILS. We have now written our first RLS loans, which is a good step forward. And I think it's fair to say as well, at the start of CBILS, it was very difficult to get an application process, to get it accepted. And that did, once the lenders and the underwriters got used to the criteria, that did become a lot easier. So hopefully we'll see the same happen with RLS.
And what about from you, Richard? Obviously, we've just heard from Toby there that there's not as much take up on the RLS scheme. What are you seeing at the moment?
Situation normal, I would say. I mean, when the COVID thing first kicked off now, so March last, yeah, it was quiet for a few months. Or quieter for a few months, and obviously there were some sector issues there. If you're in hospitality and so forth, things were not looking too bright at all. A lot of other businesses really sort of largely untouched, and some sectors probably actually doing quite nicely out of things. So we're just in the right place at the right time, I guess. But no, these days it's just full steam ahead, really.
Nice. And I think one of the big misconceptions that people have about crowdfunding is that it's not quite as fast and easy as people think, and it's not a case of, if you put your fundraise on one of the platforms, everyone will just come and invest. It's definitely not as simple as that.
No, we wish. It's actually probably not an uncommon thing for someone to say to me, the reason that crowdfunding wants crowdfunding is because it's quick and easy. So when I've picked myself up off the floor after that, it's pointing out to them that it is neither of those two. I mean, from beginning to end, ordinarily, you're looking at around about 6 months from the time you kick it off to the time you get money in the bank. And in terms of the effort, yeah, you've really got to be focused on this. This is not something you do just in your spare time or when you've not got anything else to do. So, you know, particularly if you're talking about someone, it might even be a smaller business or a newer business where, you know, they could be the one-armed paper hanger in the business and they're doing everything. It's a big ask to be running your business and running a crowdfunding campaign at the same time. So, yep, takes effort, takes energy.
Can I just cut in there? Sorry, Matt. I mean, the businesses we're working with, they're typically looking for angel investors or VC type finance, and our experience is they place really significant weight on the individual and their management team before they're making their decision. Does that apply to business owners going after crowdfunding as well, Richard?
Yeah, I mean, it's a cliche, but it's still true. You know, ultimately, people invest in people, and you know, it's everyone that comes along with their new product or believes it's the new product and service. There's not really that much that's totally new and unique these days. There's variations on a theme and so forth. And a lot of people, well, I would say in the vast majority, that's where people, investors, will look at. They'll see who's the team behind this, who's running this, where's the ambition, where's the enthusiasm, where's the drive. So no, without absolute question, I think that's still probably the number one factor.
And do you know what's really interesting there is I think that's creeping more and more into the debt market as well, is all about the people that sit behind the business. That's how we lend money. Is we don't just look at the financials first. It's all about the people in the leadership team that sit behind the business. Do we believe in them? What's their character like? What's their past experience?
Just to interject there, I completely agree. And one thing that we're coming across, especially with newer businesses, is a request for a brief CV to go with an application for the business owners, and that's a new addition. Which just backs up your point.
I think it's become even more prominent over the last 18 months. Is the character of the people that sit behind the business, particularly if you're lending them money, are they going to be using that in the right way? It's all about the due diligence that we all conduct when we're lending money or we support with a campaign. I'm sure it's about the due diligence for, like I said, the investor or the bank or the finance company to do that in the right way, isn't it?
Yeah, absolutely.
I think it's good to hear that's happening. I mean, we've all heard stories of, you know, businesses that have become over leveraged with debt, and they're actually not, you know, they're zombie businesses. They're never ever going to get out of this cycle of debt and overdraft, and they continue to get funding. So I think that's a positive move. Interestingly, there's still a bit of grant funding around, and we've just got involved with a grant in Mendip called the Revitalisation Grant, and I was on a call with them last week with the other approved advisors for that fund, which I think comes out in September, and they were also talking about a reliance on the advisors to do a bit of a finance viability check on the businesses. I mean, it's all about the project and what the project can contribute to the business and to the region, but the business has got to have some viability. If the grant is just going to go to paying off an overdraft, then it's really not being put to very good use. So it's good to hear that that's a trend in the debt market now as well.
Is that purely meant for Mendip-based businesses, Peter?
Yeah.
It's interesting there that you mentioned around viability, because that's one of the things that we assess under RLS, the Recovery Loan Scheme, is what is the long-term sustainability of that business, and do they have a long-term future? Toby, you mentioned it obviously in the introductory round. Can you give us a little bit more of an insight as to what the RLS scheme looks like in a bit more detail? Is that okay?
Yeah, absolutely. So I suppose broad parameters, first of all, that the loans start from £25,000. Other products you can access from £1,000. So that will probably be most useful for small asset purchases to help support those. As I mentioned before, the real purpose of the scheme is to give an 80% government guarantee against any loan. What they haven't done this time, as they did with CBILS and Bounce Back, is offered the interest payments for the first 12 months and the fees paid. So if you're taking out one of these loans, you can expect to start paying immediately, and there may be fees included as well. There are a standard set of British Business Bank criteria, and similarly with CBILS, we saw the same thing, that can then be interpreted in a number of different ways, and that's where different lenders will have different approaches, and they may make different deductions on your affordability, offer over different periods, and there will also be a range of interest rates. So that's where it might be worth sort of scouring the market to find the best match. And maybe don't take your first no as no, this is impossible, but maybe no, you need to try elsewhere. Yeah.
I mean, if a recovery loan doesn't fit, Toby, what other types of finance are you seeing that are available to businesses?
So more traditional types of finance, so asset finance and invoice finance, as we mentioned at the top, are returning to the market, or lenders are returning to the market. I think it's probably fair to say that credit criteria has tightened up, but that's probably at the more marginal level. So strong businesses can still get very cheap asset finance. I did a deal recently that was a 1.48% flat, which is the lowest I've ever seen, and that is current market. But I suppose I would say that those pre-COVID, a lot of businesses relied on unsecured loans because they just saw it as a very quick, easy way of getting money that they can then use as they need, and that will definitely become more difficult unless you can access RLS.
Okay. What about you, Matt? You were saying earlier you're really seeing a lot of activity right now, which is good, I think, because that means businesses are beginning to wake up and look to how they can come out of lockdown as fast as possible. Are you seeing activity outside of RLS as well? Are you seeing lots of other, overdraft, or because I think you do asset finance or invoice finance as well, don't you?
Yeah, so I think the big thing is it seems to be very sector specific. I think, Richard, you mentioned it earlier on, is different sectors are recovering or trading at different levels. The sectors that we're seeing a lot of activity in at the moment, and also success in, is recruitment. Seems to be a very buzzy and vibrant sector at the moment. We're starting to see bits and pieces around manufacturing. Any kind of professional services firms, so we look after a couple of accountants and lawyers and architects. They seem to be doing well. Construction is the obvious boom sector at the moment, with people not going away on holiday. Toby, I'm sure you're seeing it
as well, because pre-COVID that was seen as for a lot of lenders that was seen as a riskier sector, but it's amazing how quickly things can change, isn't it?
Yeah, and the final sector that we're starting to see do well is hospitality. And I think that's because there's been this pent up demand for the last 15 months. And, I've seen one of my customers in the hospitality sector has had a record 8 to 10 weeks of trade. They've never known levels of trade like this, but at the same time, they're really struggling with staffing. So, like I said, I think the RLS will really benefit those hospitality businesses, because they're the ones that are looking to recover the most, given what's happened over the last 18 months.
Do you see
good to hear they're back?
Yeah, it is good to hear. I mean, Richard, do you see any particular sectors that favour the crowdfunding approach? Because it is a little bit of a longer lead time to funding, isn't it? And also, as I understand it, most crowdfunding platforms don't release the money unless they actually the money pledged, unless your target has been reached. So, what's the kind of proportion of people that you're seeing who are making target versus not making target, and are there sector preferences or any sectors particularly suited to?
I mean, and your first, one of your earlier comments there around it's all or nothing. So that's the situation with the major platforms and the crowd cubes of the world. So yeah, you either hit your target or you don't. I mean, for the want of a shameless plug, we haven't had any of our clients fail their targets for, I don't know, 3 years or something like that now, but there's a reason for that. There's a structure to putting together a crowdfunding campaign, so doing that properly is right. I mean, in terms of the sectors, things like retail and certain types of quite specific retail are doing pretty well. Funnily enough, medtech type stuff is kicking through. We are seeing something in the general sort of construction, so people that are involved in sort of housing estate on that type of stuff, that's coming through. Probably one of the sectors, and I was interested in what Matt was commenting there, ordinarily, exceptions aside, you don't usually see a hell of a lot of professional services type stuff. doing too well in crowdfunding. I guess some of the reasons for that is it's not necessarily seen as, or those sort of businesses aren't seen as scalable. I mean, I'm sure there'd be certain of the big five who would argue that, but they're not seen as especially scalable. And also there's the big question around what's the return for the investor. And generally speaking, people are going into crowdfunding investments on the basis that one day there's going to be some sort of liquidation event, there's an exit or whatever, they're going to get out with big bucks. Of course, that's not necessarily the case with professional services stuff, but that's changing. So we are seeing those sort of things coming through now, particularly when there's a tech element behind it. You know, you might be into the accountancy services, legal services, various things like that that do have a tech element behind it, and they've got a definite eye on a game, saying, okay, in 5 to 6 years, this is the plan, and this is how people are going to get their money out of it. And I suppose one of the differences, but it's something to be conscious of for crowdfunding, particularly or almost exclusively for newer business. There's the whole thing around tax relief schemes, SCIS and EIS, which can make those investments very, very attractive for investors, for earlier stage businesses, higher risk, etc. And of course that makes it a little bit unique on that side of things.
Good. I mean, we've been going a few minutes now. Perhaps it's time to just kind of bring this to an end. But there's one kind of last question I'd like to put to all three of you, really, and that is, what should a business owner be doing to put their business in the best position to gain the finance through whatever route it is that they're going down? And Richard, you were talking about, it needs a campaign, it needs to be carefully managed. So maybe you could start and just kind of offer a few tips there as to what businesses should be doing. Yeah,
it's a question you got to spend 20 minutes answering, but know your story, know where you've come from, know where you're going, be confident about it, and be able to answer the obvious questions, I think, is the most important stuff. Particularly in the game that I see, investors aren't necessarily looking at 5 years worth of blow by blow, month by month financial forecasts to judge the viability. They really want that entrepreneur type person or that business leader saying, this is what my business is, this is where we're going, this is what we're trying to achieve, this is how the investment's going to help us get there. Businesses, or the people behind them, stumble at those sort of questions, and I've certainly seen them stumble. There's an instant loss of confidence there, particularly, and I have seen this. Someone says, okay, you're raising £1 million, how exactly are you going to spend that? Not quite sure yet, but we're working on that. Well, kiss of death. So just know what you're about.
Yeah, absolutely.
I was going to say, that's really interesting, Richard. I'd be curious to know, Peter, your view on that, because obviously you mentioned that you're working with businesses looking to gain access to funding via investors. What are what's your top tips?
I mean, I think I'd probably agree with much of what Richard has just said. I mean, investors are investors, whether they're crowdfunding investors or an angel standing in front of you. I think the one thing I would add is, when we're working with a client, preparing them for the eventuality, they're producing clearly the vision and the plan, which has to be viable and sensible, but also a financial forecast that's based on assumptions. And you can't produce a forecast that's not based on assumptions, because it's the future. Nobody knows what's coming. My top tip for them always is make sure you understand what assumptions you're making and you can justify them. And we have a forecast model that because it's a model, you can build your assumptions in it and you can change them. So if the investor turns around and says, well, that assumption you've made about market growth in this sector, we don't believe that, you say, okay, well, this is why we think that's right. But if you want to change it, let's change it and see how that impacts the model. So having that flexibility, that agility, and that knowledge. I mean, often if a business owner turns to an investor and says, this is what we're going to do, it's absolutely on the nail, then they will have no interest in them whatsoever, because it's a forecast and nobody knows what's going to happen. But if you go through that process, you build an understanding of the mechanics of the business you're talking about and asking for funding for, and being able to defend those assumptions, but also flexible enough to change them and understanding how they might change, I think that builds confidence in the investor or the potential investor.
100% agree with that.
Yeah. Sorry, Toby, your top tips.
So I would just say record keeping is very important, both internally in terms of your sort of accounting package, whatever you use, and externally filing stuff with Companies House, making sure that you keep your credit score as high as possible. But then also actually really to echo the other guys, forecasts and business plans are more important than ever. So as one single simple tip, I would say revisit your business plan and bring it up to date.
Cool. Cheers, Toby. And I guess from me, probably just echoing what all three of you have said is around, you know, from a bank's point of view, is if you, I think it was Richard, you mentioned that, you know, you say, oh, here's £1 million, what are you going to do with it? And people go, meh. You know, what's the point in lending you £1 million? And the other thing that doesn't quite marry up is when you see a request for funding and you don't see a need for the funding either. That's another big flag. But for me, it's all about preparation. Make sure you know what it is you want. Make sure you know what your business stands for. So both the numbers side, but also the story that sits behind the business is, for me, equally important.
Yeah. All right, fantastic. Thank you very much, everybody. I think there's a lot of insight that's come through this conversation so far, and hopefully all you people out there watching it will remember that Matt West at Metro Bank and Richard Mojel at ISQ Crowdfunding and Toby Jones at StartPoint Finance can help you to get the finance that you need. So thank you very much on behalf of myself at hgkc, and see you next time. Thank you. Bye-bye.
Cheers.
Thanks all.